So what options are available for a person who can't pay their debts?
Okay, so there's a number of things that a person that can't pay their debts can do from a formal point of view. So let's say they can't negotiate with their creditors. They might have quite a few creditors, might be credit card debt, it might be guarantees, their business might have failed and people are chasing them for under personal guarantees. So they can enter into a number of formal arrangements. One could be what they call a Part 9. So it depends on what assets they've got, what liabilities they've got, what income they've got. But if it's maybe just consumer debt, so in other words, it might be just credit cards or phone bills, they might enter into a Part 9. That's done by a debt administrator. If it's a little bit more complex and there's a bit more debt there, they might enter into a Part 10 arrangement. And that's, again, where a proposal is put to creditors, and if it's better than what would be available in a bankruptcy, the controlling trustee will recommend to creditors that they should accept the proposal. We'll do some investigations into the person's affairs, and we'll make that recommendation, and at a meeting of creditors decide whether or not that proposal should be accepted.
Steve, just sorry on that, what's the difference between a Part 9 and a Part 10?
Well, Part 9, there's not a huge amount of reporting, and the debts are generally quite low. And generally it's more for consumer type debt, like small credit card debt, those sort of things. Normally somebody that does a Part 10 arrangement normally has a lot higher debts, and normally it's brought about through maybe the failure of a company where they've got personal guarantees,
Right.
but the debt's a lot higher. And so if the proposal is accepted, then all the creditors are actually bound by the proposal, and they'll get paid. Normally it's cents in the dollar that they get paid, but ultimately then once the deed has been complied with, the person's then let off their debts that existed at the time they entered into that arrangement.
And does that, for both Part 9 and 10, how does that impact their credit file?
Yeah, it will appear on their credit file.
Yeah.
So,
okay.
And it disappears once the period of time, which I think is probably 5 years,
5 years
elapses.
Yeah.
Ultimately, the other arrangement is a bankruptcy. So the person declares themselves bankrupt, and a trustee is appointed. Bankruptcy lasts for 3 years.
Right.
It's not designed as a punishment, but it's a protection for both the individual and also creditors. A trustee is appointed. A trustee will realise any what they call divisible assets, and there are quite a few assets that aren't divisible. So, for example, superannuation, a motor vehicle up to the value of $8,000, some tools of trade, are not divisible assets, clothing.
And when you say divisible, Steve, you mean?
Like a house property, for example, or shares, maybe antiques, expensive jewellery, those sorts of things are divisible property, which means that that property is available to realise for the benefit of creditors. So it lasts for 3 years, and after 3 years, as long as the person's cooperated with the trustee and the trustee hasn't objected to their discharge, they're automatically discharged from bankruptcy.
Right. And you can still, for those people who are unaware, in terms of when you go through bankruptcy, you can still work and earn up to a certain income?
You can still work and earn any income. So, what happens is that after a certain amount, you've got to make contributions to your estate, to your bankrupt estate. So those amounts are all set out in the government website, which is afsa.gov.au. But they change. The rates change depending on how many dependents you've got. So the more dependents, the more that the threshold amount actually is before you've got to make contributions, and it's 50% after tax that gets made. So, if you're earning $200,000 or $300,000 a year, you'll be paying contributions, but you still get to keep 50% of the amount after tax. So it's certainly worthwhile.
And have any of the rules for personal bankruptcy changed during this period?
only what creditors can do in terms of making somebody bankrupt. They've now got to have a debt of more than $20,000 and they've got to make 6 months before they can actually commence the bankruptcy proceedings.